Hey folks, how are you doing? In today's video we will take a look how to invest for the beginners. And you've probably heard some stories when someone bought shares of a certain company 10 years ago when that was super cheap, and by now that person is a millionaire or a billionaire. Or you may heard that some people just keep investing, and what is that kind of investing stuff, and they're just growing their money and how they do that. And today we'll talk about whether you need that, whether it's difficult to find out what's investing. And some people think that investing may be super difficult thing to do and you have to be super smart to do that thing. So we'll talk about that today as well. So first of all, without any investing, what happens to our money over a time? If we take $100 and put it on the table today, what will happen to that $100 in 1 year period? And most probably you have heard about something called inflation. And yes, inflation is a thing which making our money worth less over a time. And the average inflation of the United States dollar for the past 25 years has been around 2.5% every year on the average. And because of that, our money is losing its value if it's just not working, if it's sitting on one place. The same thing if we take that money and put to the safe deposit box, for example, to a certain bank, because we wanna secure our money and make sure that it will be safe, but actually our money will not be safe in safe deposit box in the bank. It will lose its value anyway. And so what we can do with our money to secure it and to stop it losing its value, and maybe to multiply even a little bit. We can start doing our own business, but sometimes it's not that easy, and most of the people actually do not know how to start business. You need to have a lot of money, a lot of capital to start that business. You need to have partners, you need to have ideology, and you have to know the market and to pay all your attention there. All your time, all your resources. So starting a business is kind of difficult thing to secure our money. The next thing we can try doing is to buy a real estate and rent it out and then earn money from that rent. But again, buying a real estate is kind of difficult process. You have to know where to buy, for what price, what to look at, and you have to maintain that real estate. And definitely over a time it will gain its value, but you need to be proficient at buying real estate. It may be a little bit more complicated than most people think, even more complicated than investing. The third thing you can do with your money and to secure it, you may put it to the bank deposit, to a savings account. And that may look quite reasonable, but mostly for United States dollar, the interest rate for that deposit account is around 2% for 1 year. And if you still remember, the inflation is around 2.5%. So that deposit will not even cover the inflation and your money will still lose its value. And so there is one more thing you can do with your money, is you can start investing in the stock market. And it's actually not that complicated as most people think, and the average return rate for passive management of your portfolio without touching it, just keep investing, is around 10% every year. That 10% will definitely cover the inflation, so you will save your money, and it will also help you to gain more money and you will even earn. And that's a great tool for those people who do not have big capital to start, who don't want to put all their efforts and attention to maintain that kind of thing. You just keep investing passively and you can save and even earn more money. So what the investing thing is? It's basically something you buy and then it increases its value over time. And if you're talking about the stock market, on the stock market you can buy stocks or shares. And basically share, it's a portion of the company. And by buying a share, you're becoming a co-owner of that company. For example, one share of Apple costs $178. So by paying $178, you will buy one share of Apple. Two shares of Apple will cost $178 times 2. And if you want to calculate the price of all shares, of Apple company, then we have to $178 multiplied by total number of the shares, which is around 16 millions of shares. And the result will be $2.9 trillion. And that will be the total price of that Apple company. So as you can see, share is basically a piece of the company, and all of them together will cost exactly as the company costs, the market price of the company. And so gaining money on the stock market will basically mean that you will buy some shares for a certain price, and then over a time that price will increase in value, and that will be your gain in the capital. And so the next question you may kind of ask me, how to buy a share? Alright, I want to start investing, how to buy a share. For buying a share, you need to have a contract with a broker. Before, in the old times of Wall Street, there was a real person who was taking the phone, you were calling to him and saying, alright, I want to buy shares of that company. Today, it's all online brokers. So basically all you need to do is to go to Google and type something best online broker and then your country, because those brokers may differ from country to country because there are different regulations in different countries, and those brokers have different commissions, rates and all that. But basically you don't have to go anywhere physically, you just can sit at your home if you're having your phone or laptop, and you can register and open an account in any online broker that you will find suitable for your country without going anywhere physically. For example, I'm using interactive brokers, but I know that in US there is very popular Robinhood or something like that. So you just basically, as I told you, can find something that fits for you, that has low commissions and that is easy to use for you. And actually the banks, they have sometimes their own application, like they have a bank and they have a broker with the name of that bank. Sometimes it happens like that, and you can actually open a broker account in your bank, and for you, in your case, it may be more convenient. And basically after opening an account in the broker, you will have either a web page or a phone application where you can buy shares. You need to deposit that account, and after that you can buy shares on the stock market. Next question, which shares to buy, how to choose a share to buy, how to choose a company, and how to find out which is the best one and that will give you most profits. Because as you know, how the company is dealing in the real world, how many sales it has and how much profit it's generating, is all reflecting to the price of the stock of that company. And you definitely want to find a good company so that your investment will not only be the same in the price, but will even increase more. And if you're a beginner, and if you're watching this video, I suspect that you are, that you definitely don't know how to choose shares, and you definitely don't want to do that, especially in the beginning, because if you invest in a single share of a single company, for example, even if it's the best company in the world, if it's Tesla or Facebook, you still have a big chances of losing your money because you kind of put all your eggs in the one basket. And most common things which especially beginner investors do, they invest not in a single shares, but they invest in index funds. What is an index fund? Actually, I have a video about index funds, mutual funds, and ETFs and difference between them. You can check it out. But in short, index fund is basically a pool of money that different investors bring together, and then they invest those money in a certain index. And index is basically a list of the companies. For example, the most common index in the US is S&P 500 index, and is basically a list of top 500 largest companies in the US. So I hope you've got the idea. Instead of investing in a single share, by buying the shares of index fund, you will invest in 500 biggest, largest companies of the US, and that definitely reduces your chances of losing your money because it's 500 companies and basically you're well diversified among them. And that index included such big companies as Apple, Google, Amazon, Johnson & Johnson, Tesla, Facebook, which is now Meta, and so on and so on. And even such companies that you even don't know their names, but basically this is something you want to do in the beginning, to invest in index fund rather than in a single company. And what is special about that index funds, that they're just investing in that index. So index is a list of the companies and they're investing in that index. They're not choosing any other companies to invest in. So in other words, it's passive index fund. So there is no real person choosing shares to invest in. There is already index, which is followed by this fund, which actually, unlike active management, usually performs better, because active management is something like when there is a real person who is choosing which shares to buy, and sometimes you actually do not know which shares included in a certain index because it's kinda secret. And there is one investor, it's actually one of the most richest persons in the world by now, successful investor, Warren Buffett. And in his annual letter to the shareholders, he wrote that he would invest now at this moment 90% of all his investments to the S&P 500 index. And actually in 2008, he had one bet with hedge funds, which were actively managed. And Warren Buffett said that those active managed hedge funds cannot perform better for the next 10 years than just passively managed index fund that is following S&P 500 index. And guess what? He won that bet. By the end of only 9 years, it was absolutely clear that the index fund that was simply following the S&P 500 index was outperforming all of that hedge funds. The total cumulative result for index fund was 85.4%, and the result for those hedge funds was that the first was getting result of 8.7%, the second was having result 28.3%, Fund C had results of 62.8%, and so on and so on. And so average hedge fund result for that 9 years was 22% of return versus 85.4% of index fund return that was following S&P 500 index. And if you take a look of that S&P 500 index, the historical price of that index, then you can clearly see that the general trend for that price of that index is generally increasing most of the times. There are some downturns like in crisis like 2008 and coronavirus crisis, but eventually the stock price anyway goes up because the economy is always growing in the long term. In time period of 1 or 2 years or 3 years, it may be not that clear, but if you zoom out and take a look at the whole picture, you'll clearly see that it's always growing. And there is a common thought that people think that investing is risky. And what I can tell to that you can actually lose money in the investing if you buy something for one price and then you will sell it for lower price. But why would you do that, knowing that eventually that index will anyway grow up? So the only enemy here in investing is investor himself, because only investor can make actually mistake. Because if you're investing in 500 companies, then there is no mistake you can do except selling something for a worse price than you bought it. And the main rule for investor is investing in the long term, because eventually everything is growing up. If, for example, today you take a look at the price of the same index, which was back 2 or 3 years ago, you'll realize that that price compared to today's price is so cheap that you would be happy to invest in that price today. And the same thing you will say in 3 years after today. Today's price is super good for the price of that the same index in 3 years, and you will realize it maybe only then. But there is absolutely no reason for you to start panicking when the index price is going down, and this is actually the only thing you can make mistake in, is basically selling your assets, which is kind of not reasonable, knowing this what you already know. And if for example, suppose those 500 largest US companies are going down and for example they are bankrupt, all of them, then I suppose in the world will be bigger problems than just stock market going down and that will be the least problem that you have. So the next question, you may ask me when to start investing. And the general answer is to start as soon as possible. I started earning money myself in 2016, and I generally regret that I did not know about investing thing at that time, because I would be a lot more richer by today if I did investing at that time, knowing all of this information you've got in this video. But there are 3 things you should ensure before you start investing. The first thing, you have to make sure that all of your debts, all of your credits are paid off and you don't have any debts, because you want to finish them first and then start earning money. So finish your money from reducing and then start thinking about earning money. And the next thing you want to do is to make sure that you have a safety pillow. This is kind of reserve, your personal reserve, in case you will get ill and you will lose your job. So that safety pillow should be sufficient for you to live without receiving any other money for the next 3 to 6 months. So ensure you have that safety pillow. And the third thing you want to make sure before you start investing is that that money that you put for investing and that money which you buy shares, you will not touch them for the next 5 to 10 years and even more, even further. Because if for some reason you will want to withdraw your money with a lower price than you bought it, then in that case you will lose your money. And the longer you will keep your money into this investing thing, the more it will grow into, because there is such thing as compound interest. If you're getting 10% of return, then if you're putting $100 to the investment today, then on the next year, this time you will have $110. And then the next year after that, you'll get 10% out of that $110. So you'll have $121 and so on and so on. So basically you will receive percent of that percent. And reinvesting that money that you are receiving is the best thing. Not withdrawing it from your investment, but basically putting it back to the use, to the investment thing, and producing even more money with that money which you've got from the stock market. And for example, you have decided, alright, I want to start investing because this is kind of good for me, good for my pocket, good for the economy. What is the strategy that you should follow? How much money you should invest and how often you should invest? And there is one perfect strategy for the beginners, and it's actually not only for the beginners because it's showing perfect return results. And that strategy is so simple and so boring that most of the investors are trying to beat the market, doing some other things, and they actually in most of the cases cannot, as the statistics show. So the best thing to follow here is to be patient, to simply invest in that index, and to have that simple strategy of investing, which I'm gonna tell you now. And that strategy is called dollar cost averaging. It's basically when you receive your salary every month, you take some amount from that salary, let's say 10%. So 10% every month you get from your salary to put in the investment portfolio. And you wanna invest that 10% of your monthly income to your portfolio and buy those shares which you already bought, no matter what is going on in the market. If the market is up, you are buying. If the market is down, you are buying. You're constantly buying, no matter what news, what things going on there. You just keep buying, especially if the market is down. It means that the price you're buying is cheap and eventually your investment will cost more. And actually this is the hardest thing to do with your investment, is to follow a simple, even dumb strategy, simply investing each month your money in that simple and boring index, and that's it. Alright, the next question you may think about is how much money you need to have to start investing. And people saying that you can start investing from $1 or something like that, but alright, let's forget about all that and take real numbers. What is the real amount of money that you can start investing with? And let's take a simple example. The cost of the Vanguard S&P 500 index fund is $423. So I think it's quite a reasonable amount of money which you can start with, is buying one share of that ETF, which costs $423. And even sometimes you may start with less amount because some of the brokers, they allow fractional shares. Means you can buy a piece of that shares, means 0.5 of the shares or 0.1 of the share. And if you have that broker, then you can actually start with absolutely any amount basically that you have. And even if your monthly income is not that big, it is still important to start putting aside that 10% of your income for the investing, because it builds a habit. And building habits and building a patience and strategy is one of the most important things in the investing actually. And as you know, the 90% of all errors are caused by human. Human error is cause of 90% of all mistakes in the world. And the biggest enemy of the investor is the investor himself. So one more time, easy guide how to start investing in short. You need to choose a broker, open account at that broker, fund that account, choose a shares that you want to buy and buy that shares. Ta-da! You are the investor and now you are the owner of the largest companies in the US and in the world. And there is such thing as taxes. I want you to know about this. It's actually a thing which you would like to find out before actually start investing. And taxes are different for different countries, so you can find out the taxes for your country. But generally there are two types of taxes. Capital gain tax is when you buy something for one price and then you sell it for a different price. But in case if you keep investing and keep buying, then you don't need to pay any taxes if you just keep buying something. And the second tax is actually for the dividends, but that is in case if you're buying some shares that pay dividends, because not all of the shares are actually paying dividends. But the main thing for you now is to start investing and keep buying. If you will keep only buying, then it will be super cool, because anyway you'll have to pay taxes generally only the next year. So start investing right now, and buying shares is the most essential thing that you can do for yourself. Alright, I hope it was useful, you enjoyed. Thumbs up please for this video, and see you in the next video. Bye!